Hey there, thanks for joining me for another deep dive. I'm coming off of last month's EPCOR Payments Conference, also known as Payments Palooza, and today I want to dig into a topic that was really resonating with our attendees and was heard around the conference room halls, and that's Pay by Bank. Pay by Bank is beginning to really gain some traction in the industry. It's been on conference agendas the last few months, different events that I've attended, and it's a topic that financial institutions should have their fingers on the pulse of as it's gaining momentum, especially through open banking applications like Plaid and others. So while the term Pay by Bank has been used loosely in the past, its definition is still a little bit murky, and better clarity is really necessary for adoption and risk management. As Mike Kern mentioned last month at our conference, the Nacha Pay by Bank project team is just one of the industry initiatives that's leaning in to reach industry consensus on the meaning of Pay by Bank. What's a clear definition? What are use cases? And then what are associated risks to mitigate? Nacha highlights 5 key attributes for Pay by Bank. So first off, Pay by Bank transactions are electronic only. So we're not dealing with the dreaded check here, not cash. They're also account to account or A to A transfers, meaning they're paid from a DDA or checking or savings account, which completely bypass the card network. Transactions are rail agnostic, meaning they can flow over the ACH network, RTP, or FedNow, and this flexibility is really its key strength. Transactions can be credit transfers as well as direct debits, including when end users are pushing credits or when a merchant through an authorization is direct debiting an end user's account. Lastly, Pay by Bank uses open banking technologies, which leverages APIs to connect the accounts to initiate those payments, which provides for a seamless mobile-first experience. And this is what truly differentiates Pay by Bank transactions from a standard online ACH payment. So why are businesses and consumers gravitating towards Pay by Bank? The use cases are pretty compelling, and they represent a significant opportunity for financial institutions to regain or recapture market share from the higher cost card networks and payment service providers. So for merchants, Pay by Bank offers lower cost alternatives to the credit and debit card interchange fees, which we all know can be significant. And this is particularly attractive for high volume or high value transactions, making it an awesome fit for e-commerce checkout and for those large B2B invoice payments. End users can certainly simplify recurring payments for things like paying utility bills or subscriptions by merely logging into their banking app with just one single secure authentication and sending the payment that way. And then when you look at leveraging real-time payment rails like RTP or FedNow, Pay by Bank can offer instant settlement, which for merchants really allows them to improve their cash flow and their working capital. For financial institutions, offering Pay by Bank enhances that client and member engagement by meeting their demand for those more modern and convenient different types of payment options. Now, just like everything else, with something new comes new risks to proactively manage. So let's take a look at some of those, shall we? The primary concerns for financial institutions center on 2 areas with Pay by Bank: security and operational processes. And while direct from bank authentication is inherently more secure than just, giving someone your credit card or debit card or your account numbers, Pay by Bank is not immune to fraud. And the primary security risk here shifts to social engineering and phishing. So where the fraudster is tricking the consumer into sending or initiating that credit push payment to a mule account. For mitigation techniques here, you want to think about real-time fraud monitoring systems, especially when you're looking at instant payments, and an aggressive institution-wide education program to really help highlight what those scams are, looking at social engineering, business email compromise, and impersonation fraud. Irreversibility and dispute resolution are two key considerations in terms of your operational processes. So unlike the card networks that have those established chargeback rules or ACH debits where we have processes for unauthorized transactions, many pay-by-bank transactions, especially those that are going over FedNow or RTP, are final. And this reduced risk of chargeback is a benefit for merchants particularly, but it creates a challenge for end users who are the victims of fraud or error. Because consumers don't care how they make a payment, they're not well versed in the different rails or the rules, and really should they be? But this presents a potential customer service nightmare when what they ordered is the wrong color, it's the wrong size, it's the wrong brand, and they can't get a refund immediately because they're used to those card protection rules. So you need to make sure as an institution you have clear internal dispute resolution processes and communications to mitigate that risk. And for debit-based pay-by-bank like ACH transactions, you have the existing Nacha rules for unauthorized debits. Those still apply. But when you're looking at credit push payments on instant rails, you really need to have a response strategy. As you focus on operational readiness, remember the reliance on APIs and open banking technology. It means that you as a financial institution must ensure your internal systems, your integration frameworks, and the third-party partnerships that you have are secure, they're resilient, and they're compliant with all relevant regulations, including KYC and AML. And the regulatory environment is evolving right along with innovation. So when you look at the CFPB's personal financial data rights rule, it aims to give consumers greater control over their account data, right? So creating both, compliance responsibilities for you, but also opportunities for trusted financial institutions to lead in secure, consent-driven open banking. So staying ahead of these changes will position your bank or your credit union to deliver pay-by-bank solutions confidently and compliantly. Pay-by-bank is definitely emerging as a new leader in payments landscape, offering the potential for lower transaction costs like we talked about for businesses, greater convenience certainly for end users, and new opportunities for financial institutions to reinforce their role as trusted providers at the center of the payments ecosystem. While adoption is still in its early stages for pay-by-bank, but momentum is definitely building through pilots and industry collaboration. So now's the time for you to begin reshaping your strategy. What does it look like? What technology do you need for your tech stack? Strengthening your fraud defenses and making sure to stay attuned to industry and regulatory guidance that's constantly evolving. As always, EPCOR is here to help you navigate this evolving landscape, and I thank you for joining us for another deep dive. I'll see you next time. Take care, everybody.